when you have a recession in an emerging market, the currency goes down, the stock market goes down, and yields go up. And if he does this with our balance sheet where it is, and you've already been seeing this, you're going to see the stock market down, the currency down against gold, and yields up. And that will be the thing that's a real mind blower. Is I think if he does institute a recession, you're going to see Treasury yields rise, not fall, until it gets, at least maybe not immediately, maybe for the first couple, 3 weeks, a month, but then you're going to see them like you did in March 2020, bottom and Treasury yields start to rise into a recession. And that's going to set off all sorts of alarm bells in Washington.
There's the Treasury markets volatility index, the MOVE index. It used to be the old Merrill Option Volatility Index, which was invented by Harley Bassman as well too. That's at a 12-year high. The volatility index is at a 12-year high. The yield curve was a year ago 180 basis points, 2s, 10s, and it's down. It hit 20 basis points, or actually slightly under it, earlier this week, and it's like around 23 basis points right now. This is all happening before the Fed actually raised rates. That's coming next week, the very first rate hike. We have never inverted, I've been tweeting this out and saying, we've never inverted the yield curve before the Fed started raising rates. It always comes at some point in the rate hike process. Well, we got a chance of doing that. The yield curve has already narrowed or flattened, come in 20 basis points in the last week, and it's at 20 right now. So all what I see in the market is, and if you look at floating rate OIS spreads, which is a measure of unsecured loans from banks versus secured loan from banks, like a version of the TED spread, that's widening rapidly. It's still at a low level, but its rate of change is going straight up. All of this is happening before the Fed raises rates. All of this is happening, and as I mentioned earlier, today is the last day of QE. We haven't gotten to tightening yet, and the market is looking not very good right now. And so we haven't even leaned on it yet. It's just the talk of leaning on it has created all of these issues. So yeah, I agree that the bond market's not in a good way. And I get it. And people look at it and go, what are you talking about? It's 189 in the 10-year. It was 189 a week ago. So it sounds like it's okay to me. Well, yeah, but the way the bond market works is it's kind of looks okay until it's not okay. And then it kind of all goes sideways at once. So there are definite warning signs out there right now that there is problems with the bond market. And we haven't even started leaning on it. And when we start leaning on it, we'll have to see how much worse it gets.